Ladies and gentlemen, good day and welcome to the Westlife Development Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. We would like to remind you that certain statements made by the management in today's call may be forward-looking statements. These forward-looking statements reflect management's best judgment and analysis as of today. The actual results may differ materially from the current expectations based on a number of factors affecting the business. Please refer to the safe harbor disclosure in the earnings presentation. I now hand the conference over to Mr. Chintan Jajal. Thank you, and over to you, sir.
Thanks, Michelle. Welcome everyone and thank you for joining us on the Westlife Development earnings conference call for the first quarter ended 30th June 2022. I am Chintan Jajal, Lead Investor Relations at Westlife. From the management team, I have with me Mr. Amit Jatia, Vice Chairman, Ms. Smita Jatia, Managing Director, Mr. Saurabh Kalra, Chief Operating Officer, Mr. Akshay Jatia, Executive Director, and Mr. Datta Prasad Tambe, General Manager, Finance and Accounts. We shall commence today's call with overall operational progress highlights by Smita, followed by financial review by Datta Prasad, and strategic outlook by Amit. We will be referring to the earnings presentation and financial releases which are available on the stock exchange as well as investors page of our website. With that, I now turn the call over to Smita. Thank you and over to you, Smita.
Thank you, Chintan. A very good afternoon, everyone. I hope you and your families are all keeping safe. Today is a moment of great happiness and I am proud to share that for the third time in a row, we have outperformed ourselves to post remarkable results. Our strong performance in the first quarter, irrespective of macroeconomic and inflationary challenges, was underpinned by highest ever quarterly sales and operating profit, reflecting broad-based momentum across all segments. Our revenues for this quarter are up by 108% year-on-year and 18% sequentially. The same-store sales growth for the quarter stands at 97% year-on-year. We have delivered a strong 5.38 billion revenue and recorded a cash PAT of over rupees 551 million. It was heartening that we continued to see healthy growth across West and South markets, with the average annualized sales per store not just remaining over rupees 60 million, but hitting a new milestone of rupees 67 million, supported by our recently opened restaurants, which are performing at par with the system average. Our growth in both dine-in and convenience channels has been continually setting a new baseline for the business. While dine-in grew over pre-COVID levels, convenience platform business has more than doubled, underlining the success of our omni-channel strategy. Despite strong inflationary pressures, we have recorded highest ever quarterly profits. Impact on gross margin was partially mitigated by pricing action. Our operating EBITDA stood at 17.1% for the quarter, led by favorable operating leverage, cost optimization initiatives, and improved productivity. We sustained QSR traffic share gains in most of our markets by focusing on elevating our brand, accelerating digital channels, and showcasing our core equities of burgers and chicken. Owing to our multi-channel, multi-day part strategy, we were able to serve our customers wherever they are, whenever they want it and however they want it, further cementing our market leadership position in West and inching towards leadership in South. We consistently find new ways to reach our customers where they are and make their experience more seamless and personalized. Our omni-channel strategy has given us better business predictability, and in the first quarter, digital channels, which include our mobile app, self-ordering kiosk, and delivery, made up more than 55% of system-wide sales. Building on our strength, we have renewed focus on expansion and offered a differentiated experience through reimaging our stores, creating experience of the future. While the reimaging dramatically improves the customer experience, we have also seen a tangible benefit of over 30% return on incremental invested capital. This quarter, we have opened 5 new restaurants. With this, we have a total of 331 restaurants, 267 McCafes, 65 drive-thrus, and 132 restaurants across 48 cities. We are proud to launch the Gold Standard drive-thru with an all-women crew near the Statue of Unity in Gujarat, which further strengthen our inclusivity agenda. Furthermore, I am happy to see that Tier 2 cities have grown twice the pace of metros compared to pre-COVID levels. While we were a bit shy of our intended new store opening target, 12 new stores are currently in ground break. With that, I believe we should have around 17 to 19 stores in the first half and on track to add 35 to 40 new restaurants in FY23. We have been making concerted efforts to build and strengthen our brand trust and business through menu innovation, business initiatives like Real Food, Good Food campaigns, McDonald's in every celebration, amongst others. Lastly, at Westlife, we have no stone unturned to create a great place to work for over 10,000 people strong family. And I am elated to share that we were awarded the prestigious Great Place to Work Laureate Award as one of the top 3 companies for being in the top 100 list for 10 consecutive years. I now hand it over to Datta Prasad, who will take you through the financial highlights of the quarter.
Thanks, Smita. Good afternoon, everyone. We started FY23 on a strong note. Our revenue for the quarter was up by 108% year-on-year and 18% quarter-on-quarter to rupees 5.38 billion, with the same-store sales growth of 97% year-on-year. Dining channels grew by 418% year-on-year and 14% over pre-COVID base of Q1 FY20. Convenience channels grew by 13% year-on-year and 112% over pre-COVID base. Despite significant inflationary pressures in food and paper, impact on gross margin was limited to about 70 basis points, sequentially mitigated by price hike and improving product mix.
you for joining the call today. Hope you are keeping well. You just heard us report highest ever quarterly sales and operating profit, highest quarterly sales in the McDelivery app, the highest ever monthly sale in dine-in. We achieved a crucial milestone by crossing rupees 5 billion sales this quarter. We are consistently outperforming our benchmarks every quarter, and with the Q1 FY23 numbers, I'm proud to share that Westlife Development is witnessing the next wave of growth, beginning of the next wave of growth. With robust and consistent results for 3 consecutive periods despite external challenges, it demonstrates that we have built a resilient business that has delivered results and is set up for the long term. What makes Westlife unique is the strength of our people, the scale of our supply chain, the quality of our real estate portfolio, the agility of our system, the power of the McDonald's brand, and moreover, consistency in our strategic approach. We have believed in our core, stood firm, walked the talk, and execution is now paying off. Our agility to identify industry shifts early on has helped us deliver a differentiated experience. Be it our experience of the future stores, our world-class drive-thrus, our digital platforms, every engine is geared to make the consumer experience seamless and fuel growth. To summarize, I would like to say that while I'm proud of our progress, we are constantly challenging ourselves to invest in the future. We are on track with our expansion plans of opening over 200 stores in the next 3 to 4 years. We expect this will be a year of continued progress, focusing on our foundation of operations excellence, expanding our growing digital advantages, and continuing to put the health and safety of our customers and crew first will remain critical. We will tackle any challenges with agility and a strong focus on execution. With a redefined cost structure, increased productivity, strong average unit volumes, and healthy restaurant cash flows, we are well positioned to deliver accelerated business results and create long-term value for shareholders. With that, let's open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. An operator will take your name and announce your turn in the question queue. Participants are requested to use own handsets only while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Percy Panthaki from IIFL Securities Limited. Please go ahead.
Hi, sir. Congrats on a good set of numbers. My first question is on the dine-in business. If I look at the dine-in ADS, only the dine-in ADS on a sequential basis, Q4 versus Q1, there is a growth of around 30%. And it wasn't as if Q4 was terribly depressed. There was an Omicron impact, but it was the least intensive of the 3 waves. And apart from a couple of weeks, people were up and about their business. So just wanted to understand that in one quarter, what has changed so much that the dine-in ADS has gone up by 30% in just a 1 quarter period? Any insights on that would be helpful, sir.
Sure. Thank you, Percy. See, as you've noticed about Westlife, for us, it's all about consistency and sustainability. And therefore, to some extent, these are building blocks. I mean, this is sort of the 3rd quarter post-COVID where the results have been good. And if you look at pre-COVID, probably for almost, I would say, 16 quarters, we were positive same-store sales growth, growing our average unit volume year-on-year, quarter-on-quarter. So obviously, things like this don't happen because of tactics. Things like this happen because of strategy. And again, if you hear our calls or read our commentaries, it's all consistently built around 3 or 4 themes. First thing, of course, there is a structural shift in QSR and in informal eating out. where I have mentioned this before, that Western fast food is taking larger share within the informal eating out itself. The second big thing that is happening is that within Western fast food, brands that have a high trust score and that talk about safety, hygiene, contactless, and I think we've done a number of campaigns around that, they are seeing a slightly bigger benefit than maybe some others. Thirdly, there are a number of strategic elements that we've consistently been following. Earlier it was about, say, McCafe only, and then it was about, say, experience of the future and so on. But while these continue to grow, we've added a few new building blocks to it. So, for example, if you look at our slide number 9, we've given a lot more context around menu relevance and its impact around consumer occasions and day parts. We have very transparently talked about going after the meal occasion, and the linkage to that is the launch of our fried chicken in South India and the gourmet burgers. And clearly that has started reflecting back in our sales. So it's a combination of all of this. Last point I want to make is around McCafe, that we had mentioned this in our previous calls as well, that McCafe has been impacted because it's got a tremendous experiential consumption pattern as well. And as in-store came back, McCafe sales have bounced back pretty well as well. So this is a combination of the reason why our in dining is doing quite well.
Got you, sir. Got you. And I completely understand and fully appreciate the good sort of initiatives that you have continuously undertaken over the last several quarters. My question was more in the sense that, see, all these initiatives that you spoke about were present in Q4 as well. So just in a 1 quarter period, what has really changed for the dine-in ADS to go up so sharply? Does it mean that in Q4 the Omicron impact was actually so much more huger than what we understand?
Yeah, Akshay wants to answer that.
Hey, Percy. So, as we've discussed, obviously, yes, there was an impact of Omicron in January where dine-in was partially open. There were restrictions. There was a capacity constraint. A lot of states were going in and out of lockdown. So we don't know exactly what, the overall impact could have been, but there was an impact on overall quarter delivery, which is evident as we ramped up in, February and March. However, if you see our performance this quarter, it's largely, firstly, the first quarter of the year, with summer holidays, with festive period to an extent, is pretty good. And secondly, obviously it's the first normal period post-COVID where customers are going out again. So dine-in has come back, not that we don't expect to continue to see this momentum, because like we just discussed right before this, there's a fundamental shift that's happened for the category as well as for brands like ours, where customers are a lot more familiar, they're a lot more used to eating out at a McDonald's, and it's something that they now look for consistently. And we've seen that growth both in frequency as well as, average ticket size when families are coming back to our restaurants. And most recently, we've just put out some, communications in our advertisements centered around our new campaign revolving around family.
Okay, got it. My second question is on margins, and I'll break it up into 2 parts. So one is on the gross margin front.
numbers. I have a few questions. Just wanted to understand the presentation. You stated that you are on the verge of becoming the market leader in South India. I just wanted to know who is bigger than us in the burger segment. I thought that we are one of the largest player in the burger segment in South India as well.
Sure. So we don't look at market share from a burger point of view. Burger, we are by far the leaders across the whole country. But we look at leadership in what we call informal eating out. And in informal eating out, one of the big factors was chicken. And our recent launch, which is now sort of over 12 months, is resonating extremely well, and our average unit volumes there, as I've said in our calls earlier, has risen per restaurant per year by 50 to 75 lakhs, 5 million to 7.5 million per year. And therefore, we think that it is still going to continue to grow. We believe that the consumer in their mind have to still connect, and I feel that is an opportunity. They have to still connect brand McDonald's with a chicken, fried chicken sort of a menu item. And I feel that is where the opportunity lies to take it to the next level.
So I'll just add a little bit flavor to this. In the South, we saw that the eating out was dominated by bone-in chicken and chicken. And hence we took this insight, and that is where we are playing with along with our burger leadership. So together we are confident that with burger and chicken as strong portfolios, we will be able to get even higher leadership in the South market.
Got it. Thank you. Second question on reason you stated that tier 2 cities have grown faster than metro. So my understanding is maybe because in those markets, dining-in share would be higher. That could be one of the specific reasons that tier 2 cities have grown faster than metro. Any other reason apart from that you are seeing on the ground why the cities have done better than metro cities?
Again, I will go back to what Amit mentioned. There's been a whole shift in the IEO structure where organized players after COVID are getting better share of the wallet because of food safety, hygiene, contactless. And this shift is not something which was momentary. We are seeing that it is definitely staying on. Secondly, again, convenience as a habit has got built in small towns. Which was predominantly first dine-in. So because of both these factors, there is a new baseline, and as I mentioned in my commentary also, that small towns and new cities are now coming at system average and not becoming a lag for the first 1 year.
Okay. And just last question on McCafe, as the sales recovered to pre-COVID levels now, because this was the first quarter where we saw the store being operational fully for McCafe sales. So any comments on McCafe would be really helpful.
Sure. No, it has recovered to pre-COVID levels. And as I've always said before, that we have two big opportunities. One is, of course, to put it across our portfolio of 330 restaurants. So there's an opportunity of 18 and 19 new McCafes right there, which we are, of course, doing. And on the other side, the average sales per McCafe per restaurant per annum, we believe that over time is going to double again. So there's tremendous opportunity on this beverage category there.
Okay. Thank you so much, and all the best for the future endeavor. Thank you. Yeah.
Thank you, Vishal.
Thank you. The next question is from the line of Avi Mehta from Macquarie Capital. Please go ahead.
Hi, Amit. Am I audible?
Yes, Avi.
Amit, congratulations on this performance. Really good to see those numbers. Just wanted to kind of pick your thoughts on, the AOVs. For the last few months now, we are essentially stabilizing at an annual run rate of close to about 6 crores. I cannot see any reason why this should moderate down given your initiatives. But if you could give me a sense on what could be potential risks which could drive this down, or how should I look at that?
Sure. So Avi, again, we've been, you've been on our calls regularly. I've seen that. And you'll see the consistency in conversation. If you look at global McDonald's, firstly, we've given a lot of sort of insight into our thinking across our investor day and particularly more in the earnings deck. Again, slide 9 represents a lot more than what is sort of evident to everybody. And if you recollect, I've been always saying that the real game for McDonald's in India is yet to play out. So first, let's take coffee alone, and I just talked about how we can double it in the restaurant and double the average unit volume. Again, if you look at meals, we haven't touched the tip of an iceberg. We were leaders in snacking, and we are starting to now move towards leadership in meals. As you can see from that slide, meals is a much larger segment and a much larger occasion for the consumer than snacking. So as we grow that, all of this leads towards AUV growth. So in the past, I had given specific ways of how we would get from 5 crores to 6.5 crores, and that was around McCafe, it was around menu, and it was around delivery, right? And all of these three things have played out. Now we've added a new dimension while these are still playing out, and I believe this is what will take us from the 6.7 to the 7.5 crores. We feel the game's not over. Globally, McDonald's plays across all these segments and average unit volume is $2.6 million, pretty much the highest in the category. And even if you look at Asia, Asia pretty much stays in the $2 million category. And when I compare Indian countries along similar to Indian per capita, they are at least over 10 crores plus. And we have a whole bunch of stores that are in that category as well. So aspirationally, we don't think that it is going to slow down. I've given you some context to how it's going to move, and Smita just wants to add something.
So just to put it very simplistically, Avi, basically all our growth in AUV has come from strategic platforms. It's not at the back of any discounting or one-time promotion. And therefore, we are confident that all our strategic platforms, which Amit just mentioned, will continue to play out both on delivery and dine-in.
So if I kind of summarize or, if what I understand is logically this 6.7 should rationally move to say 7.5 as these initiatives kind of gain pace. That's a right way to look at it, and how AOVs kind of flow through to margin. So that would be the right, at least the expectation going forward. Would that be a fair thing?
Absolutely, absolutely. And I've been saying this too, that at least at Westlife we have two jobs to do. One is of course completely increase penetration because there's a huge opportunity there. But we also have been talking consistently about growing our average unit volume. Because I'll give you one example. I mean, some time ago, our average unit volume was 5.5 crores. Today it is 6.7. So when you take 1.2 crores and multiply that by 331 stores, you can see the impact of that is 400 crores in incremental sales without putting any more capex. While new stores will keep coming and they capture a different set of elements of unpenetrated markets. So we believe that this double benefit is what's going to take our margins to our aspirations, which are much higher than where we are.
So the only one small caveat I would like to put in there is that we are going to now accelerate on new store openings. So that will keep our AUV in the range of 6.5 to 7. However, if you look at our comparable stores, definitely we are going to be giving our com sales, which is something which we've always been focused at.
But if I may, just differ on that logically, right now, if you're at 6.7, your existing stores would be much higher. So that's why I was actually moving towards Amit.
That's where our ambition lies.
Okay. And if I hear you correctly, you'll be sharing an updated guidance in the vision document soon. Is that?
Yes.
Sorry, did I hear that correctly?
Yes.
Okay. I'll wait for that then. Thank you very much. Thanks a lot. And again, wish you a lot of luck in the future.
Thank you all.
Thank you.
Thank you.
The next question is from the line of Kapil Jagasia from Edelweiss Financial Services. Please go ahead.
Congratulations on great set of numbers, sir. So my first question is, like earlier we used to follow this cluster policy of opening the stores in the major metros, around 70% of the stores in major metros and 30% in the smaller towns. Now with this intensifying competition, have we changed our strategy there, or it would continue to remain a breakup of or a mix of 70-30 going forward?
Okay, so our strategy around store openings has nothing to do with competition. It has to do with unpenetrated consumer areas that we should be focusing on. So, for example, in Mumbai today, we are by far leaders, and Mumbai is a consumption market. We have over 100 restaurants here, and at least in sort of our immediate competitor base, we have a huge margin in cities like Mumbai, Pune, Ahmedabad, our 6 core cities, including some of the cities like Surat, Baroda, etc. So we don't want to lose our leadership there. So you will continue to see openings in that area as well. Meanwhile, we are going to now accelerate we are only in 48 cities, and I see that as a positive rather than as a negative. Our strategy has been focused inside out, it has been clustered and so on. But as more and more clusters have opened, it has now given us the ability to go into small towns as well. So that's how the openings have moved from 25-30 to 35-40, which will now go towards the 50-60s if we want to deliver our 200 stores over 3 or 4 years. So we will not reduce the numbers. Percentages keep changing. We will not reduce the number of openings in our core markets, but we will add a lot more openings in our smaller cities as well. And therefore, it will become a 60-40 kind of ratio.
Okay, thank you for that. And sir, as this normalcy has now resumed in the restaurant space, so what can be the same-store sales growth for next 2 years or 3 years for us, like average ballpark number?
See, I've always maintained that, a good number, which is, I feel, quite aggressive, because remember, same-store sales is compounding. And now, if you are at 5 crores average unit volume and you grow 10%, that's 50 lakhs. When you are at 6.7 crores and grow 10%, that's 67 lakhs. And rupee is what the consumer spends, not percentages. So we are saying aspirationally, if we can stay above 8% same-store sales growth, I feel that sustainably that's a good number to go by.
Okay, thank you for answering that. Congratulations on that.
Thank you.
Thank you. The next question is from the line of Nihal Mahesh Jham from Edelweiss Financial Services. Please go ahead.
Yes, thank you so much and congratulations on the strong performance. So 3 questions from my side. The first one was that while you've given an SSG number, I was just interested in understanding that if you compare the same base of stores to the pre-COVID quarter of Q1, what would be the improvement over that for the stores that are currently there?
Our same-store sales growth pre-COVID.
Yes.
Saurabh, you want to answer that?
Yeah, so if we take it versus pre-COVID, and I was to take Q1 FY20 as a proxy, we would be around 30% more same-store sales than that number.
30% on absolute level versus Q1 FY20.
Yeah.
Perfect. That's helpful. The second question was on the chicken part of it. In Mumbai, I've noticed that I think there has been a pilot launch in certain stores. That is, I've seen it in certain.
Ram, your voice is breaking.
So sorry.
No, you're not audible. I would request you to speak on your handset, please.
No. Ma'am, I'll come back in the queue. Sorry.
Okay, thank you. The next question is from the line of Gaurav Chogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir, and congratulations on the strong set of numbers. So my first question is with regards to a comment in your PPT, that you have given that even the new stores are now performing at the same par with the system average. So if you can throw more light on it, what is leading to this and how sustainable is this going ahead?
Okay, sure. I mean, see, obviously the brand keeps getting built. And what happens is, if I use a simpler example to make my point, you take Mumbai. Today, we've been in Mumbai for 25 years, and therefore our presence and availability is there. But yet, let's say there's an underpenetrated area. Let's take, say, a suburb, Westlife. Right now, when we open there is familiarity with the brand. People have consumed McDonald's somewhere or the other in the city regularly. And therefore, when we are opening there, we are seeing, the average volume starting off quite well to start with. Similarly, in small towns, we are seeing, that the numbers are starting off pretty strong, much different than what it was earlier. So this is what we are observing, and hence the comment.
Sure. So that's very heartening to know. And sir, my second question, is with regards to the strong sustenance in the convenience channel. So if you see, it's almost, now 2x versus the pre-COVID levels, and even grown at a strong base of 13% odd. So, where do you expect this to stabilize in a normalized environment? Once things stabilize, what percentage contribution do you expect going ahead from this?
I think what you are seeing today is where it's going to be. And if you recollect, I mean, again, I feel that we've been very consistent in our comments. I had always maintained, I mean, at that time, everybody was asking me why are stores not smaller, this, that. And I would say that dine-in is going to come back to 100%. People are not going to just keep ordering. They need a change. There is a reason why people eat out, right? That is sometimes to celebrate. It is about refueling on the go and things like that. So we believe that that is here to stay. And therefore, we believe, however, convenience is also here to stay. We are continuing to aggressively build drive-thrus, our on-the-go is working, takeaway is working, delivery. So I think 58, 60% and 40% is a good number. Globally, of course, our convenience channels are almost 70%. So I feel over a 5-10 year horizon, that's where we are going to move. But for now, I feel 60-40 might be where we will be.
Sure, sir. And so just follow up to this is that, now with the new contribution structure, saying 60-40 that, we're expecting ahead, how does this help in our margin profile then? How incrementally does it contribute to our margin profile?
See, margin, as I mentioned to you, as we keep growing average unit volume, okay, the margin flow through will come. I think between delivery and in-store and all now, there is not much of a difference. I have always maintained, on every call over the last 5 years, that if business is happening somewhere, you have to make your unit economics work there. Yeah, we have to go where the consumer is. We can't have the consumer coming to our business model. So now between delivery and in-store, there are pros and cons to each. And both business models for us are working well. So we look at, as long as average unit volume keeps rising and we keep cost in control, both I feel we are pretty strong in both these areas. You will see margin flow through come in. And I feel now we have history, right? I mean, even in the really difficult period of 14, 15, 16, 17, every year we were improving our EBITDA by 130 basis points. So for us, it's about sustainability, consistency and strategy, not tactical. So you will see that flow through come irrespective.
Sure. Sir, that's very helpful. And just one last bit on, the comment earlier made in terms of, the mark-to-market gain. Actually, I just missed that bit of the one-offs. If you can just repeat that, it will be really helpful, and how it changes the other income line item for us.
Sure. So DP, can you please take that?
Yeah, hi. So basically, his name. So basically, what has happened is in Q4 FY22, when we sold off around 700 millions of our investment, as per the accounting standard, the mark-to-market gains which were recorded in the previous period had to be reversed. Now, when the reversal happened, it happened in the other expenses in the SEBI format. Okay. Whereas the realized income was in other income. Now, typically for an EBITDA margin calculation, we exclude the other income, and thereby the mark-to-market gain reversal also has to be excluded, which when the investors, you calculate the EBITDA margin through SEBI workings, it was getting excluded, which we have separately reported now in our SEBI results.
Oh, okay. So basically the Q4 numbers for that has been restated to that extent, right?
Yeah.
If that understanding.
It's typically a one-off of Q4, yeah.
Sure, but just one thing here, the other income for this quarter, seems to be a bit lower to that extent. And, given that we are making good cash profits, so how is this other income, expected to be ahead? Because for this quarter, it's just around 1 million odd if I total up.
Yeah, I feel DP can take that, but I feel it's just to do with mark to market on our treasury. That's about it. So that keeps fluctuating. It's not a big deal, but Prasad, you can answer that.
Yeah. So basically what has happened is in this quarter, as you know, with the repo rate increasing by almost 90 bips, the overall valuations in investment has gone down, which is typically a market phenomena. Okay, that's the reason we are having, if you look at it, results, we are having a mark-to-market loss this time. Okay, that's the reason.
Okay. Okay, good. Thank you so much for this. Best of luck for saying.
So thanks, Gaurav. Thanks.
Thank you. We have Mr. Nihal Mahesh Cham connected again in the queue. Please proceed with your question, Mr. Cham.
Am I audible?
Yes.
Thank you so much, sir. Apologies for that. Sir, I was asking on the chicken part of it. I've seen the soft launch in Mumbai. I just wanted to first confirm that, and if you could share metrics where you shared the run rate for the South stores. Is it similar in Mumbai also for the store that you've launched the chicken portfolio?
Yeah, so it is a soft launch, Nihal, and we don't share sort of results this early. And it's a 5-6 store test, and we have a whole process of what we do. So it's too early to talk about, and it's not even to measure sales. It is more to get all the operational aspects right and get a first cut view on consumer qualitatively. Quantitatively, 5-6 stores don't give you enough. So it's too early, Nihal. The important thing is, yes, there are some restaurants here that have the product.
Understood. And do we have a timeline of when we plan the rollout for the 100 plus stores in Mumbai, or that's depending on how the pilot progresses?
No, yeah, I mean, no timelines as yet. It's all sort of, our philosophy is keep working on Horizon 2. So while Horizon 1's playing out, you need to keep working on tomorrow's initiatives. And since this is done very well in South, it's part of that program. So, it's all, there is a lineup. And our priorities here could be quite different from maybe the fried chicken. So no plans as yet to sort of give out, but whenever we are ready, we will come back with that.
That's helpful. Just one more question from my side was that you've obviously highlighted on the menu innovation part in the presentation. And over the last 18 months, there have been multiple SKUs across day parts that we've launched. So incrementally, what are the parts that you think are still missing and where you want to keep innovating and adding, menu innovations?
So that's, sort of hard to explain on a call, but I'll tell you, 2 years ago, 3 years ago, if I would have said gourmet burgers, the context would not be understood. I believe that our menu is still a tip of iceberg. And I'll use McCafe, it's easier to explain. In McCafe alone, we just played primarily on core products right now. Yeah, there is no innovation, there is no indulgence as yet. So for example, take smoothies. While we have 2 or 3 smoothies in there, I remember a global program where we had taken smoothies on television and, sales really, really shot up for smoothies, not just at McDonald's, but in the whole category. So similarly, in McCafe alone, there is tremendous menu play. Even in our core menu, there is tremendous menu play. Whether it's to do with burgers, whether it's to do more work on the chicken side, whether it's to do with wraps that we've not talked about, our desserts. Dessert again is a $300-400 million market, and we've just touched the tip of an iceberg. But McFlurry is the hero there, and there's a lot of work that one can do. Breakfast is another area. So therefore, my whole point is that there is a lot of work to be done, but if you have to prioritize it right, otherwise your energies can get dissipated without results. So it's a big subject, but the important thing is we've just touched the tip of an iceberg. There's a lot of room to grow our menu.
Sure, sir, that's helpful. That'll be it from my side. I wish you all the best. Thank you so much.
Thank you. Thank you, Nihal.
The next question is from the line of Jay Doshi from Kotak Securities. Please go ahead.
Hi, thanks for the opportunity and congratulations for extraordinary results and progress on ADS. My question is, when I look at 1Q FY20 versus 1Q FY23, dine-in is broadly comparable, maybe about 10%, 14% higher, but convenience channel has gone up from roughly about 1.5 crore annualized revenue per store to 2.8 crore. We've added 1.3 crore again in a quarter where everything has opened up and there's a push for dine-in. Can you provide some more color? And first, a bookkeeping question: is takeaway a part of convenience, or only on the go is convenience?
No, I don't think that takeaway is part of convenience. Takeaway is a part of dine-in. Saurabh, please confirm that.
So this is effectively drive-throughs, delivery, and on the go. Can you sort of provide some color in terms of what, when you look across these three sub-channels within convenience, where have you seen maximum traction, and what explains this kind of stellar performance? We don't think any other PSR player has managed such.
Thank you, Jay. We appreciate. So while of course I cannot provide specific details, but I'll tell you that remember we are in the convenience business, right? QSR is all about convenience. And for example, we've been talking about on the go for a while. I'm just using this as an example. Now, obviously, nobody really took that seriously in our comment. But today, on the go has become a very decent size of our business. Of course, we feel we want to grow that as well. Of course, as dine-in came in, that sort of played down a little bit. The other big one is take drive-thrus. Yeah, drive-thrus I feel is a major play for us, because even globally, we do enough business through the windows that could justify a whole restaurant. And, we have 65 drive-thrus and the plan is to double that. And what happened through COVID is that the habit for using the drive-thru got formed, and that habit has not dropped, it's only growing. So it is things like this that outside of delivery also continues to grow. We are watching the rupee amount of delivery which continues to grow, but it is these 2-3 other incremental things that have also helped grow our convenience channels. And therefore we believe that it's going to continue to grow, particularly with the effort we are putting around drive-thrus as well. Saurabh, Akshay, you all want to add anything to this?
No, Amit, no addition from my side. I think you've covered it up. I think drive-thru is a big focus for us as we grow more and more drive-thru. We should be able to get the traction in more and more restaurants as we grow drive-thrus.
Yeah.
Great. I hope that answers the question to some extent.
Sure. Thank you so much, and good luck.
Thank you.
Thank you. The next question is from the line of Amnish Agarwal from Prabhudas Lilladher Private Limited. Please go ahead.
Yeah. Hi, Amit and team. Congrats for a great set of numbers.
Thank you.
Yeah, I have 2-3 questions. My first question is that for us, Tier 2 cities, they have done very well this time around, and their throughput has grown at double the pace. So can you share with us that you can say how much is the sales contribution coming now from Tier 2 cities, and what is the throughput per restaurant there in terms of, say, like for example, we are at 1.6 crores per quarter per store. So how far that your number would be for a Tier 2 that city?
Sorry, I mean, we don't break up our sales by the Tier 2 cities and all of that. And neither, sorry, I can't share that breakup.
Okay, but just giving some direction, that is it significantly different from where you can say the Tier 1 or metro cities would be?
No, it's not like that. It's very different. You see, it's all about age of the city as well. So particularly, it's hard to tell you that. The important thing is that it starts off very well and it continues to grow. But remember that in a Tier 2 city, finally you can build 1 or 2 McDonald's. You can't build 5, 10, 20. And therefore, the volume that it does and it comes to system average, we are quite happy with that. So in summary, whatever best I can tell you, it is starting off very well Earlier, it would take 2 to 3 years to build to system average. Now it is starting close to or maybe sometimes ahead of system average. And the good news is that it is continuing to grow. So remember, yet 80% of our stores are still in tier 1 cities. So, this is building out, and I feel it just shows the opportunity for growth more than anything else at this point.
Okay, that is pretty useful. Now the second thing is that if we look at the current quarter, our dine-in is 58 and delivery or convenience channel is 42. Now pre-COVID, this number was far lower. So do you believe that now dine-in will, you can say, sustain around 58, or do you think that convenience will pick up from 42? What is the long-term trend which you are witnessing in both the channels?
Yeah, as I answered this a little while earlier, but I'll repeat that. One, we are a convenience brand, and it's all about impulse purchase. So globally also 70% of our stores is off-premise. 70% of the consumption of our business is off-premise. So I feel it is here to stay. And as I said, 60-40 is a good base for us to work on. And longer term, if it moves towards, I'm talking 5-10 years as the category matures, going towards 65% is where I see India at, very long term.
Okay, so 65% dine-in you are saying?
No, long term. Right now, you please take it as 60-40. I'm saying as the category matures over 10 years, that is where it could go to at best.
Okay. And finally, fried chicken, I think we are, you can say, piloting the same in a few stores in West India. But in how many stores in South we have launched this product?
South, it's across the board. So I don't know, we have 170 stores, maybe 200 stores. I'm not sure of the exact number. Probably 170 stores we have in South India, and it's across the board. In West, it might be in 5-10 stores somewhere in Mumbai.
Okay. Final bit on the royalty. So as I think it was stated during the initial remarks that it will now move up gradually to say 5% by 25-26, and you are in negotiations with the parent company. So do you think that it will eventually go to 8, or there is a probability that it will goes to say 6.5 only, which is the maximum paid by any other, you can say, your global brand in India?
No, basically, see, the important thing was to just clarify. I think the rest is speculation today. The important thing is that it's at 5% till FY26. Our contract is at 8% after that. And essentially, all we are saying right now is that it's not going to go from 5 to 8. It is going to be a gradual increase, and we are working through it. By the way, globally, McDonald's is at 8% around the world, including in markets with similar per capita income. That's because they bring something to the table. And if you think about it more deeply, that you see, as brand McDonald's, we have, for example, chicken and coffee as well. We don't need to build other brands or bring in other sort of operators, licenses to be able to be leaders in these segments. And I'll just leave it at that for now. But the main point is that up to 5, there's clarity up to FY26. And after that, all we are saying is it will not go straight to 8. There'll be a gradual movement which is being discussed with the parent.
Okay, Amit. Thanks a lot, and congrats on that.
Thank you.
Thank you. As that was the last question for today, I would now hand the conference over to the management for closing comments.
I just want to take this time to thank everybody for being on the call with us today. I really appreciate it, and have a lovely weekend ahead.
Thank you. On behalf of Westlife Development Limited, that concludes this conference. Thank you for joining us, and disconnect your line.